Hey, what's going on, YouTube? We are going to go through Adobe Inc., ticker symbol ADBE. They reported their last earnings March 14th. They actually missed severely on their GAAP actual EPS, beat on revenue, but on normalized EPS, they beat by about 10 cents there. We look over here for analysts. In the last 90 days for revisions, 14 up and 11 down. So a little bit of a mixed bag there for analysts for this next coming EPS expectations. So their next earnings report comes out in about 8 days, 7 days there. But in their most recent report, back in March there, we come down here, we can see Adobe repurchased about 3.1 million shares during that specific quarter. Total revenues for Q2 outlook came in at 5.25 to 5.3 billion versus consensus of 5.31 billion, so slightly below consensus, which is probably why you saw, at least on that specific day, shares were down about 5%. Also, the board of directors have declared a new $25 billion share buyback program. And also, Wall Street, this is one of the sentences that I kind of liked, is that Wall Street's expressing concern about the company's ability to make money from artificial intelligence in the short term. That's perfect for us because then we can potentially pick up Adobe at a cheap price because of the short-term outlook of Adobe and their AI expectations, which I would imagine you kind of have to have a little bit of faith in Adobe to think that they will pull through and find ways to make plenty of money on artificial intelligence. So over here to our valuation spreadsheet, we are going to take a look at Adobe's previous and historical financials and see how they've performed. We got a revenue, gross profit, and net income, all three trending higher. And we come over here to net income on its own page, slightly leveling off here in this, $5 billion range in an annual basis for net income. Down here to margins, gross margins continue to get a little bit better. Looks like year over year there, sitting at last quarter 87.8%. So very good there. Net margins though, we can see last quarter down to 12%. And once we get over the 10Q, actually it's the 10K, we'll get an understanding of why that got cut in half like that. But in the trailing 12 months, 24.1% net margins. Historically, they've done a lot better on margins. So it'd be really nice to see them start to get their margin back at least a couple percentage points. Maybe 28% would be pretty fantastic. And if they do implement artificial intelligence, maybe there's an opportunity for margins to expand over here at Adobe. Down to return on invested capital sitting at 28.3%. We got a PE ratio currently sitting at 43.5. So on a historic basis, probably in line with valuation of where it's historically been. Cash to short-term debt, we can see here not enough cash, which is in the blue bar, to cover its current short-term debt. Same thing down to cash to total debt. Not enough cash to cover its total debt. But again, once we get over the 10K, this will paint a little bit of a different story when it comes to their cash to debt position. And a price to sales ratio, pretty low on where it's been historically, sitting at about a 10, and usually it looks like maybe mid to low teens there is where it's usually been, but that's only been based on the last few years there. Over to free cash flow. Company continues to produce fantastic free cash flow with nominal capital expenditures. You got free cash flow here of about $6.5 billion with capital expenditures only $330 million. We can see share count. They continue to buy back shares and just issued another $25 billion share buyback program. So we would likely continue to see shares get bought back in the coming quarters and years to come. Over to their 10K, actually, not 10Q, this is their 10K. And we are on their balance sheet. We got our cash and cash equivalents of 6.2 billion plus short-term investments of about 566 gives us roughly $6.8 billion in cash. So come down here to our liabilities. So total current liabilities we're sitting at $9.5 billion, but we have deferred revenues. So this is unearned income. So over time, this will transfer into earned income of $6 billion. So I like to strip that out because, they're going to earn this money anyway. So this is not technically a liability in my opinion. So we strip that out. That leaves them with about $3.5 billion in short-term debt with $6.8 billion in cash. So they got a good debt to short-term cash position. Then you come down here to total liabilities of $13 billion. You minus out that $6 billion. They got a little more deferred revenue right there. So overall, you're looking at a total debt position of about $7 billion with $6.8 billion in cash. So they've almost got enough cash to cover all their debts. So fantastic balance sheet and position right there. Now, another thing, retained earnings right here, we can see is $34 billion of retained earnings. This is likely what they're going to use for this $25 billion share buyback program, which is, retained earnings can be used for things such as that and other things that the business is allowed to use retained earnings for. So that's why you can see $25 billion share buyback. You're going to think, well, how are they going to afford that? Well, that's where retained earnings comes into play. So down here to our income statement, 10% year over year growth on total revenue up. This is over quarter comparison, year over year comparison as well. Down here to total cost of revenue only up 3.8%. And we got our margins here, which we know sitting roughly in the 88% range there. Then we come down here to operating income. And this is where we saw such a significant hit to their EPS. They had a one-time acquisition termination fee. So obviously they were trying to buy something, didn't happen. So it was a $1 billion hit to, it cost them $1 billion to terminate that particular acquisition. So this is a one-time thing, and this is why we saw last quarter margins cut in half. So that's why I went from 24 down to 12%. So is because of that particular cost that they had. So that left them with $900 million in operating income in comparison to last year at 15 or $1.6 billion. So you add in $1 billion to say this is what it could have been is $1.9 billion in total net operating income. And then overall, they have a few other expenses here, taxes, whatnot. So now they're left with $620 million of net income. In comparison, last year they were at $1.2 billion. Down to cash flows. We carry down our net incomes to the top line of cash flows. We get to add in some stock-based compensation, and you look and see $400 million of stock-based comp, which is kind of a significant amount. Nothing to be. It's a big. It's a large number. When you compare it to your net incomes here, you know a normal net income range, it's 30% of your net income. So it's kind of a lot of stock-based comp. But then we come down here to net cash provided by operating activities. They got $1.1 billion. You subtract off your capital expenditures of only $37 million last quarter. Leaves them with about a little over $1.1 billion in free cash flow. So fantastic free cash flows. Down here, we got repurchase of common stock of $2 billion this most recent quarter. So it might be heavy on stock-based compensation, but they are buying back a significant amount of shares with that continuing forward as well. So if not for that $1 billion cost for that acquisition termination fee that they had, they would have added cash to their balance sheet, even with a $2 billion share buyback program. So pretty solid. Really, really good financials on Adobe. So now over to the comps. I pulled up Autodesk and Oracle for comparison to Adobe here. Come down here to all of our margins and charts and whatnot. And we can see our market cap comparison, revenue, gross profit, and income comparison here as well, along with growth rates. So it looks like growth rates, all fantastic growth rates on all three companies there. Gross margins here, pretty kind of close margins on all three businesses. Gross margins sitting around, 80s, 90% on Autodesk, 71% on Oracle. Operating margins, a little bit different, but overall, Adobe does have the best operating and profit margins on the board there. Free cash flow, good free cash flow on Adobe. Same thing on Oracle, but obviously you look at the overall revenues on comparison, Oracle should have significantly better free cash flow. Return on invested capital, 28%. I mean, really all three companies have good return on invested capitals. And on a PE basis, looking like Oracle is the cheaper of the three for your price to earnings. So overall, on the board, all three companies look pretty good margin-wise. Obviously, Adobe does have better margins on the board, so and fantastic free cash flows as well. So I mean, there's nothing to hate on any three of these companies based on what we're seeing right here. So all three look pretty solid on these few charts here. So over to our calculator. Now we're going to figure out what Adobe is worth today. And I haven't even seen what this thing is worth yet. I typed in the numbers, haven't even seen the final number yet, so I don't even know what that is going to be. So we got Peter Lynch fair value sitting at $291.25 per share. We got multiples comparison sitting at 439.48 per share. Price to book, 5-year average is 15.7, and today we're sitting at 13.3 on our peg ratio. A forward-looking peg sitting at 1.83, so we're sitting about fairly valued there. And then we come over to year two, Graham's valuation, giving them $440.72 per share. Company does not offer a dividend, so we do not have a dividend discount model valuation there. So to our discounted cash flow valuation, analysts had a growth rate on free cash flow of 17%. Based on the history here, which we can see good growth, but overall, I would say I don't expect 17% free cash flow growth rate. So I put them at 4% free cash flow growth rate. And even at free cash flow growth rate of 4%, still giving them a price tag of $593.20 per share. Down here to Rule 72, we have two sources of EPS growth rate for about an average of 22. Then we get to double our current EPS 3 times. Did not want to double our current EPS that much, so I just did a little about a 2.5 double, 2.25 double for future EPS of about 50, which gives them a fair value of $547.71 per share. So now to the final valuation. Currently, we're looking at Adobe's fair market value today of $462.47, 30% margin safety, $323.73, analyst price target $617.50. Now, what we're going to do is come back over here and plug in our forward-looking EPS and forward-looking PE ratios. So EPS is 18, PE we'll call it 25, so 18 and 25. And once we plug those two numbers in, we're going to have all of our calculators change. Now our Peter Lynch fair value is, let me just make sure I got the right numbers in here. So 25 PE, 18 on EPS for forward looking. Okay, we're good to go. So Peter Lynch fair value, $500. Our multiples, 755.55. And then Graham's valuation, 757 per share. DCF won't change. We do have Rule 72 that could change slightly. I'm going to still keep it at 50, so we'll maintain that current valuation there. So then that gives us a fair market value of $631. And with the 30% margin safety, $442. So basically, forward-looking numbers here, we're basically trading at a really close to a 30% margin safety on Adobe. Now, I'll top over to our stock chart and see how our technicals are holding up. So we are currently looking at a weekly chart. We scroll out here a little bit, and there's this yellow orangish line here, which is a long-term line going back to 2017. And we can see every time it hits this line, bounces off. But recently broke through, way back through, broke through again. So I feel like that line not really in play at the current moment. Zoom in here a bit. And we do have this purple line here. This appears to be intact, a trend line that is holding. So we've had 3 bounces. We had a start of the trend, a bounce, and now appearing to have a third bounce off of this trend line. This could give us a pretty good indication that this is a new trend line for Adobe right now. We also have this green bar here. Not super significant support. You could probably move this up a bit. In this range is probably a support range for this green bar here. So if you were to move that up like that, which is probably a better area for it anyway, we have 2 support ranges, right where we're pivoting at, which appears to be a pivot at the moment. We also have earnings in a couple days. So if earnings turn out to be pretty good for this company, which could be likely, we don't know yet, but if they are good, this is a perfect spot to potentially pick up some shares prior to earnings, which is a little sketchy because you never know what earnings are going to bring. But this is obviously a very good company with very good financials. The only thing that could bring is some scare to Wall Street. But I think Wall Street is already somewhat priced in the AI scare, the short-term AI scare that they mentioned, to where if they're going to start mentioning or showing some sort of profits coming from AI that they're developing, then this could rocket right back up to potential fair market value, which is right about here. So the previous high that it just made, not that long ago, a couple months ago. So Overall, this is setting up technically very well. We got our valuation telling us that we should probably look to pick up a few shares in this range. You know, it's trading at 455, 30% margin safety. We're sitting about 442. We're not that far away from that. So we're probably sitting at a 28% margin of safety-ish. And I think on a technical basis and a fundamental basis, just based on the financials, this looks like a pretty decent buying opportunity on Adobe, but we'll have to wait and see exactly what is going to happen after earnings, if this was a good buy or not. I will likely be buying this stock tomorrow, pick up a few shares tomorrow and see what happens after earnings and see if I want to pick up a few more shares then as well. But that is it for Adobe. If you found value in this video, drop a like, subscribe, comment, and back later with another stock analysis video.